Hello, everyone. I'm Chris Sullivan. I'll be your host for the latest installment in our Swiss Re Corporate Solutions Risk Management webinar series. Today, I'm very happy to welcome back my colleague, Cole Mayer, who will discuss various approaches risk managers and brokers can utilize to help address some of the challenges brought on by the hard market. Cole Mayer is Vice President and Structurer in our Innovative Risk Solutions team, where he works with corporate and public entity customers to develop tailored insurance solutions such as parametric covers for hail, earthquake, and named windstorm, multi-year single-line products, and the various retention strategies he's going to walk us through today. I think you probably know the drill by now, but before we get into the webinar, just a few quick logistical reminders. First of all, feel free to submit questions throughout the presentation. You'll see a Q&A functionality in your lower left corner. If you encounter any technical issues, please press Control F5, and that will reset the platform. And lastly, all lines have been muted, so there's no need to worry about background noise. Okay, so without further ado, I'll turn it over to you, Cole, to get us started.
Thank you very much, Chris. So welcome, everybody. Thank you for joining. We appreciate you taking the time. We understand there's a lot of ways you can spend your time at the moment, particularly a lot of webinars. So really appreciate you taking the time today. We'll go through a number of different tools to address some of the challenges that our insureds are seeing, particularly in the kind of the risk retention area. So again, very excited to be here, and thank you for taking the time. Before we jump into the tools, always like to kind of ground ourselves a little bit into just sort of the situation we're in today. So you can see here some storm clouds, some lightning going on here. So a couple different factors that are kind of at play here, none of which will be surprising to the audience here today. The first, insured losses are rising. So obviously, values at risk continue to increase. Frequency and severity of loss continue to increase as well. Unfortunately, this trend shows no signs of slowing, as we've seen in 2020. So a difficult situation from just a loss perspective and the development of those losses. So that is then leading to, again, no surprise to anybody on the call here, quite a difficult market environment for our insureds at the moment. So, certainly due to sort of point one there, the continued losses over time, insurers are obviously shifting their underwriting standards, some quite extremely. So that's kind of leading to a few of those bullet points listed down below. So some combination of increased rates, increased deductibles or retentions, which is the area we're going to explore in a bit more depth today, as well as lower available capacity. So the confluence of these factors, if you will, and the combination thereof is leading to some pretty difficult market environments for our insureds. Finally, again, no surprise, continued COVID-19 uncertainty. So, that's kind of hitting our insureds in a number of different ways as it's hitting us all. So long-term business model uncertainty. So how will the world look, next year, 5 years from now, to the extent that this sort of permanently impacts things. Also short-term sort of revenue uncertainty, if you will. So that, again, uncertainty is leading to insureds having a difficult time figuring out what their risk appetite is and what their retention might need to be long-term. So again, a challenging environment, to say the least, for our insureds. So today's goal is really to make you aware of a number of different tools in the toolbox, so to speak, outside of traditional insurance that can be used to navigate some of this uncertainty. So we're going to focus on specifically a few different strategies or tools to address particularly increased risk retentions. So the goal again here is not necessarily to dive super deep into each of these. There's a lot of permutations of these different tools and that sort of thing, that some of which you'll see. So we won't dive super deep, but we want to get you kind of aware of these different tools so that when you have these conversations with your insureds, renewal conversations, et cetera, or as insureds, you can you kind of ticks the light bulb, so to speak, and you're aware of these tools to kind of dig a bit deeper to see if it might apply to you. Okay, so before we dive into the tools themselves, I always love this slide, this risk retention spectrum, if you will. And so I think we all kind of know this intuitively, but maybe just to kind of put words to this idea here. So there are a number of different, again, kind of tools or permutations of the tools that can fall in various sides of this spectrum. So, and really different strategies thereof. So, you know, on the left side of the screen, you have pure risk retention, right? So the insured effectively taking all of the risk themselves, right? On the other side of the spectrum, you have pure risk transfer. So I, as the insured, am transferring all of this risk to the insurance market, for example, right? Not keeping any myself. And obviously, there's a lot of sort of gray in the middle, right? As you can kind of see the color gradient go from one spot to the other. So, you know, the right answer in terms of a risk retention strategy long term often can fall in very different places on this spectrum depending on the insured's risk appetite, the insured's capital position, exposure, et cetera, right? So you'll see this as kind of a recurring theme throughout this presentation. There really is no sort of one product off the shelf, one size fits all approach. It's very much sort of customized to the insured's individual situation, risk appetite, et cetera. So, and you'll see this spectrum pop up a number of different times during our presentation here today. Okay, so without further ado, we'll dive into tool number one here, efficient fronting. So right away, we can see our spectrum here again, and we'll try to kind of show you where these tools can fall on the spectrum, although again, very often you can pull different levers within these tools to move that arrow one side or the other. So here in this case, the efficient fronting option or tool is going to fall much further towards the left side of that spectrum, towards the pure risk retention side. Okay, so tool number one, efficient fronting. So with all of these tools, we're going to kind of go through the need there on the upper left, the potential solution, how that looks on the right, and then in the kind of the bottom of the page there, we'll show a picture that hopefully helps to kind of visualize how this tool actually works in practice. So the need up on the upper left, the insured retentions are rising. That's going to be a recurring theme throughout the presentation as well. So retentions are rising, deductibles are rising. The insured, in this case, has the ability or the wherewithal and the desire to retain the risk, that sort of higher retention risk, higher retention level, if you will. Right, so they're fine retaining it. They're fine taking it themselves. However, in this case, the insured has the need to evidence a lower retention level. Right, so that could be, for example, a contract with a supplier, contract with a customer, right? And we've all kind of seen those. So the insured has to show or evidence a lower retention level in this case. So a potential solution, moving to the right box there, here the insurer, in this case, could issue an insurance policy for effectively the gap between the retention that the insured has to evidence and the higher retention that they now have in their main program. Right? So the gap between those two, the insurer would issue an insurance policy for that. Right? So now the insured, in this case, has an insurance policy that shows the proper deductible or retention that they need to evidence. Right? Then step two here, that risk is effectively sent back to the insured via typically a reinsurance agreement or an indemnity agreement, perhaps. So that risk is sent right back to the insured. So the net effect here is the insured is taking that gap themselves, right? They're retaining that higher level of risk that they were always comfortable taking, but they have an insurance policy as well in place that allows them to evidence a lower retention level. Okay, so if we look down at the bottom side of the screen there, the picture, so the blue, we've got the traditional insurance program layer, so that $25 million block there. The red block down below is the $1 million required retention, so that's the retention that the insured has to evidence. And then the difference, or the gap between those two, is that $4 million green box there. Right, so another way to say that is there's a $5 million traditional deductible, right? The traditional insurance program shows a $5 million deductible or retention. The insured has to evidence $1 million. So they effectively need that $4 million excess of $1 million green block to be filled, right? So if we trace that arrow to the right, you have that $4 million green box. So step one is the insurer in this case issues a policy for that $4 million excess $1 million gap, retention gap layer, if you will. Then step two, as we talked about a couple minutes ago, the insurer now retrocedes or sends that risk back to the insured. Again, maybe via a reinsurance agreement, typically with a captive, or an indemnity agreement, for example, with a corporate. Okay? So again, the net effect is the insurer has issued a policy for that $4 million excess $1 million gap layer. The insured, in this case, can evidence a lower deductible as they need to contractually. And yet the insured, in this case, has retained the amount of risk that they want to take. Okay, so it can be a very powerful tool, fairly simple. Obviously, the devil's a bit in the details, but fairly simple structure that allows the insured to retain the risk that they want to retain while maintaining, the proper policies and documentation to evidence in accordance with their contractual obligations. Okay, so some key considerations around this efficient fronting tool here. So on the left, the insured risk appetite. Again, a recurring theme here with all of these tools. But one of the key questions here, obviously, is does the insured have the appetite to retain that entire gap layer, that entire green $4 million layer, right? And not just sort of on a single loss basis, right? They also have to sort of think about the time component or the aggregate loss burden within that layer, right? So, might not just be one $4 million hit, but it could be 2 or 3 $4 million hits, right? So does the insured really have the appetite, wherewithal, stomach to take all of those losses, particularly in a bad year? So this is where, as we all do, I think, when we're looking at these insurance programs, it's very helpful to stress test these assumptions, right? Okay, insured, you're okay taking 1, or are you okay taking 2 or 3, right? Because that's what's going to sort of be the net effect here of this particular arrangement. So the second piece there, the fronting fee. So certainly the insurer will want a fee for this service, right? So there's no kind of pure insurance risk transfer here. The insurer is sort of taking a fee for the service and is also taking a fee for what we'll talk about here in just a second, the credit risk here. So in a way, if you kind of think about, this arrangement is sort of converting insurance risk into credit risk for the insurer, right? The insurer is issuing a policy. They're retroceding the risk back to the insured. So now the insurer has this credit risk to the insured, right? So there's not really insurance risk anymore, there's credit risk, right? So that is going to contribute certainly to the fronting fee, the exposure, the credit exposure there, as well as, potential claims handling burden, right? Do we expect a lot of claims activity that's going to put a bit more stress on the insurer's infrastructure, or less, right? The exposure itself will drive the fee as well. So a number of different factors that will ultimately drive the fee that the insurer will charge for such a service. So drilling down a little bit more into the credit quality piece. So we just talked about this a minute ago. We're kind of converting insurance risk here into credit risk. So the insurer is taking sort of a credit exposure to the insured. So the credit quality of the insured is definitely going to impact certainly the fee, as well as the potential appetite that the insurer will have, right? So the higher the credit risk, generally the higher the fee. At some point, it's possible the insurer might not feel comfortable with that arrangement anymore if the credit risk is high enough. Another lever that could be pulled at sort of various credit risk levels is the requirement for the insured to post collateral, right? So in other words, if the credit risk is high enough, the insurer might say, okay, insured, you need to post some collateral or some kind of make money available up front, right? That could be cash. Typically, that's a letter of credit, right? So there is a cost associated with that as well, right? So that all kind of needs to be factored into the overall cost of this program. So you kind of have the fronting fee, any potential collateral cost if there is one, as well as, again, that sort of increased loss burden that the insured is retaining with that sort of $4 million gap, if you will. So again, it can be a very powerful tool for insureds who are comfortable retaining that risk but have that evidence requirement. Okay, so moving on to tool number 2, and this now gets into, we asked the question, does the insured have the appetite to take, in a bad stretch of years, a third loss or a fourth loss, sort of on an aggregate basis? This is where this tool can kind of help address that concern, right? So this is an aggregate stop loss cover. Sometimes they're just called stop loss covers. They're called a number of different things, but a very powerful tool nonetheless. So we can see our trustee risk retention spectrum there. So here, again, we kind of put the arrow in the middle, but depending on the levers that you pull within these aggregate stop loss programs, and you'll see what those levers are in just a minute, you can kind of move that arrow to one side of the spectrum or the other. Right? So again, the right answer may lie in various points on that spectrum, depending on the insured's individual situation. So jumping into some of the details around the aggregate stop loss covers. So we'll kind of follow the same approach here, the need on the upper left, the potential solution on the right, and then we've got a picture down there to hopefully help hammer the concept home here. So the need, as we talked about, insured retentions are rising. Again, recurring theme. In this case, the insured has said, okay, I have the ability to retain a certain amount of risk within that higher retention, right? I'm okay taking a certain amount, but I want to cap my downside, right? I want to make sure that I don't take too much. I'm going to kind of define a threshold within that retention, and I don't want to take risk kind of above that, right? So I want to cap my downside. So a potential solution here, moving to the right-hand box there, the insurer could issue what's called an aggregate stop loss cover, which provides insurance protection for an insured within that increased retention layer if the losses, the aggregate losses in that layer, exceed a certain predefined threshold. Right? So again, the client has sort of said, I want to take this amount of risk within this retention layer, after which I want you to help me step in. Right? So another way to kind of think about this is an aggregate stop loss cover can help sort of stop the bleeding within that retention layer when the frequency and or severity of loss goes higher, significantly higher than expected. Or in other words, when kind of the losses go south on us, so to speak. Right? So these can be done on a single year basis or a multi-year basis. Very often are done multi-year, again, to sort of give the insured a little bit of sort of long-term stability around how much they're retaining within that retention layer, right? But can also be done on a single year basis. So let's take a look at the picture down there below to kind of show how this would work in practice. So we've got our picture kind of before the ag stop there on the left. So we've got the blue traditional insurance layer, again, $25 million layer. We've got our red retention layer, $5 million each and every in this case, right? So this is kind of the situation before the aggregate stop loss cover. The insured's taking $5 million each and every retention, right? If we move over to the right with that arrow there, so after we put the ag stop in place, you can see a few more boxes there. So the $25 million traditional insurance layer is still sitting on top, that blue layer. Now we've got a couple more boxes down on the bottom. So within that $5 million red retention, each and every retention layer, now what the aggregate stop loss has done is said, okay, the insured, you're going to take the first $10 million of aggregate loss within that layer over a 3-year term, right? So the insured takes the first $10 million of loss, right? So kind of 2 full losses on an aggregate basis within that $5 million retention layer, right, over a 3-year span. Then the aggregate stop loss cover, so that's that green box there, is going to step in, right? So if the losses exceed that $10 million number, now the aggregate stop loss cover is going to step in and sort of stop the bleeding, right? So that's that $15 million aggregate limit, excess of the $10 million 3-year insured retention, right? So again, going to kind of step in and stop the bleeding with a $15 million aggregate limit. Hopefully that's enough, even in a bad stretch of years. That third box there, just to be transparent again, so after that aggregate stop loss cover, that $15 million limit is fully exhausted, right? So now we're talking about $25 million of aggregate loss within that $5 million layer. Again, probably a pretty extreme situation, depending on the account. After that aggregate stop loss is exhausted, the insured would step back in, right? Again, probably a pretty extreme scenario there, but just to kind of show how that would work structurally. All right, so again, here the aggregate stop loss is really coming in and stopping the bleeding after that $10 million in aggregate insured retention there. So kind of helps cap the insured's downside, if you will. Okay, so it might help to go through a couple different kind of loss scenarios here to show how this structure would respond. So we've got our same structure there at the top, so the $25 million traditional layer. Down within that $5 million each and every retention layer, we've got now an aggregate stop loss in place that will kick in with a $15 million aggregate limit, excess of the $10 million term aggregate limit, or I'm sorry, retention that the client is taking, right? So 15 million, excess of the $10 million term aggregate retention. And then the insured would step in, again, theoretically, after $25 million in aggregate loss there. So we've got the same structure there on the top. So if we look down at the bottom, looking at these scenarios, so what you see in the table there, you've got the year, the annual loss, or the loss during that year, and then you'll see the loss to the insured, and then the loss to the aggregate stop loss. So we can kind of trace in different loss scenarios how this would look. All right, so in scenario 1, year 1 here, we've got a $5 million loss in year 1. So here, the loss to the insured would be $5 million in year 1, right? So that's within that $10 million 3-year term aggregate, right? So the insured takes that $5 million in year 1. There's no loss to the aggregate stop loss in year 1. So we move to year 2, another $5 million in loss. The loss to the insured in this case is another $5 million, right? So now we've fully exhausted that $10 million 3-year term aggregate, right? So the client now is sitting on the sidelines for a little while, right? So they've taken $10 million in aggregate loss. The aggregate stop loss up to this point has still taken 0. So now we fast forward to year 3, another $5 million loss, right? So the loss to the insured in this case, the insured is now sitting on the side. This is where the aggregate stop loss comes into the picture, right? So for this third $5 million loss here, the insured doesn't take any of it. The aggregate stop loss takes the 5, right? So here again, you've seen the aggregate stop loss sort of step in after that $10 million in aggregate loss to help cap the downside, stop the bleeding. And so if we look at the total picture here, so the total loss to the insured is 10 million. Total loss to the aggregate stop loss here is 5 million. So that's how it would have responded sort of with that scenario or that set of losses. So if we move to scenario 2 here, we can see kind of a different loss pattern, if you will, and how this structure would unfold. So year 1, we immediately come out of the gate with $10 million in aggregate losses. Right, so here in year 1, we've now effectively fully blown that $10 million term aggregate retention, right? So the client has taken the first 10, now they're on the sidelines again, right? The aggregate stop loss hasn't taken any yet, right? But it will soon, as you'll see. So year 2, we have another $5 million in losses. The insured doesn't take any, right? So it's done for a little while. The aggregate stop loss now starts paying, right? So it pays the next, so that $5 million in year 2. Year 3, we have another $10 million in losses. So still the insured is done paying, right, for a while. They pay 0. The aggregate stop loss takes that next 10 in year 3, right? So now what we've seen here is the insured has taken the first 10 in year 1. The aggregate stop loss has now taken the next 15, right? So the aggregate stop loss limit is actually now fully exhausted as well. So in this case, the insured doesn't step back in, but if you saw further losses within that 3-year period, the insured would theoretically step back in. So here, the loss picture looks sort of like this. The total loss to the insured is $10 million in this case. Again, that $10 million term aggregate retention. The total loss to the aggregate stop loss is $15 million, right? So that $5 million in year 2 plus $10 million in year 3, right? So again, same concept, stepped in and stopped the bleeding. There was just a bit more bleeding in scenario 2 than scenario 1. All right. So hopefully that helps to kind of spell out how this structure might work in various loss scenarios. Okay, so some key considerations here for the aggregate stop loss tool. Again, insured risk appetite. So how much loss, the key question here, how much loss does the insured have the appetite to retain within that retention layer, right? So in the previous slide you saw they sort of said, hey, I can take 10 million within a 3-year span, right? After that, I want some help, right? Now that number may vary significantly based, again, on the insured situation, the exposure, the losses that we might expect, the insured's capital position. So all of that sort of comes into play in determining how much risk they want to take within that aggregate stop loss retention. So the next piece, the overall cost, right? We all have to look at those from an insurance program perspective. A few different attributes of this cost here, some of which are a bit more hidden, right? So one is the cost of the traditional program, obviously, with that higher retention. So the insured kind of has to look at the premium there, obviously. The aggregate stop loss premium. So there will be a premium associated with the aggregate stop loss. The cost component that sometimes gets a little bit lost is, again, what we talked about with the front a couple minutes ago, the increased loss burden within that retention layer, right? So making sure that the client understands, okay, depending on how my loss picture unfolds, I'm going to have a much higher loss burden within that sort of retained piece of it, or the retention within that aggregate stop loss, than I might have had with just a lower per occurrence deductible. Right, so I have to factor that into the projected cost of this type of structure. So finally, the evidence requirements there. So again, we talked about that with the first efficient fronting example there, but does the insured have to evidence a lower deductible or retention, right? So in this case, an aggregate stop loss alone doesn't necessarily solve that problem, right? And because you still have that kind of aggregate retention before the aggregate stop loss kicks in. So in this case, you may have to use a different tool or a number of different kind of combination of these tools. And you'll actually see one with tool 3, what we call the virtual captive concept, in just a minute, that could step in and help solve this evidence problem. Okay, so again, aggregate stop loss program, fairly simple in concept, can be extremely powerful to help insureds, again, sort of take a higher retention, but take it in a relatively safe way that helps them sort of cap their downside. So very powerful concept. Okay, so tool number 3, virtual captive. And you'll kind of see what we mean by virtual captive in just a minute. So again, our risk spectrum here, retention spectrum. So This is another case where, we kind of put the arrow in the middle, but depending on how you pull and tweak these levers, the arrow could move further left or further right. And that really depends on the insured's individual situation and their risk appetite. Okay, so tool number 3, virtual captive. So we'll follow the same structure here, the need, the solution. We'll show some pictures here to hopefully help hammer the concept home, and then we're going to take a little bit more kind of deeper dive into a couple different examples as to how a virtual captive could look. So in this case, the need on the upper left, surprise, surprise, insured retentions are rising. In this case, the insured has decided that a captive would be a really good or effective way to manage that retention, right? But the insured can't or doesn't want to set up a captive sort of themselves from scratch, right? Incurring the costs, the admin fees, all that goes into that, right? So they've decided the captive we think would be a good way to go as the insured, but they don't want to go through the full time, energy, effort, cost, continued administration of a full-blown captive, if you will. So this is where the concept of a virtual captive, which you'll see what that is in just a second, could be a very powerful concept for them. So the potential solution, so you'll kind of see what a virtual captive is. It's effectively an insurance policy, typically multi-year, with mechanisms built into that insurance policy that sort of replicate the mechanisms of a captive. Right, so you're kind of replicating the captive mechanisms with an insurance policy as opposed to the insured having to go out and get those mechanisms with the captive itself. Right, so kind of utilizing the insurer's balance sheet, administration, infrastructure to get sort of that same value that you would get out of a captive. Right, but doing it really via an insurance vehicle or insurance policy in this case. So it's going to replicate, this insurance policy is going to replicate the mechanics of a captive with a few different attributes, and we'll talk about those in more detail. But some of those would be a multi-year term, typically. Doesn't have to be, but typically to sort of unlock the value of this concept, they're typically done on a multi-year basis. There's a premium funding component to help fund losses. You'll see from the picture what we mean by that in just a second. There's a low claims bonus at the end of the term to sort of replicate, if you will, an underwriting profit within the captive and sort of a dividend back to the parent, right? That's what that mechanism is sort of replicating. Again, we'll go into more detail on that. And then there's typically an aggregate stop loss component built into here as well, which is, again, sort of separate and distinct from a full-blown captive. Right here, we build in an aggregate stop loss component to sort of help stop the bleeding, if you will, right? If the losses exceed those funded premiums. Okay, so we'll go through in more detail exactly what we mean with some pictures to kind of help hammer the point home here. So step number 1 there on the lower part of the screen. So here we've got our same $5 million retention layer, right? Here the insurer would issue a policy for that desired retention, so a $5 million insurance policy. For step number 2, here the insured would fund a significant portion of that limit over time, right? So in this example, I've got, the insured funds $1.67 million in year 1, another $1.67 million in year 2, $1.67 million year 3, right? So they're funding effectively a full limit, right? Kind of one full limit within that $5 million retention is funded by the insured. Right, so that's kind of replicating, obviously, the captive premiums being paid into the captive to then pay the losses, right? So that funded premium is, in fact, then used to pay the losses, right? So the losses come in year 1, year 2, year 3. And so in this case, those gold boxes there. So you see $1 million in loss each year in this example, right? So that $1.67 million each year, or $5 million for the term, in funded premium is used to pay those losses. So the insured funded $5 million in funded premium. The losses were $3 million, right, as you can see in each of those boxes. So then step 4 is that low claims bonus at the end of the term. Right, so here the insured would receive a low claims bonus if the premium or the funded premium exceeds the losses. Right, so that mechanism is replicating a dividend back to the parent, a captive dividend back to the parent after an underwriting profit. And so you can see how some of these mechanisms built into this insurance policy are really replicating the mechanisms of a captive in this case. So let's dig a little bit more detail into a couple different potential scenarios. So one of the big questions is, okay, I've funded all of this premium as an insured. What if the claims exceed the funded premium? What happens, right? So there's a couple different roads we can go down there. One road, as we talked about a minute ago, is an aggregate stop loss component, right? So I'm going to show you kind of how that looks with this picture, and then we'll go through a couple scenarios here to show how this might function. So step one, again, the insurer issues that policy for the $5 million retention insurance policy, right? In this case, a 3-year insurance policy for that $5 million retention. Step two, the insured funds a significant portion of that premium. Again, here in this case, we've got that same $1.67 million in funded premium each year, $5 million over the 3-year term. Here, we're going to incorporate an aggregate stop loss. So the insurer is going to pay that $1.67 million in funded premium used to pay claims. They're also going to have a separate aggregate stop loss premium. So they're going to pay for an aggregate stop loss, which I'll explain how that steps in just a minute. Okay. Step three, same as before. The losses roll in. That $1.67 million in funded each year, or $5 million for the term, is used to pay those losses. Step four here, this is where it's a bit different, right? So here now, the losses have exceeded the funded premium, $1.67 million each year. Here's where an aggregate stop loss, which was paid for with that aggregate stop loss premium, could step in. Right? So the aggregate funded premium over the 3 years is that $5 million. If losses exceed that, now there's an aggregate stop loss, that green box in place to step in for example, the next $10 million. Right? So this is one way that, again, the insured can sort of go down this road, this captive road, but also this virtual captive road, if you will, and then, but also have this aggregate stop loss in place to help stop the bleeding if the losses exceed that funded premium. Right? So it's kind of a safer way for them to enter into this space than if they did a sort of a captive from scratch, right? And they would just have to fund if the funding, the premiums weren't adequate, they would just have to recapitalize the captive. Right, so a good way to, again, help kind of stop the bleeding there. So if we look at a couple different scenarios here, so kind of following the same pattern, year one, in scenario one here, we've got $2 million in annual loss. We've funded $1.67 million, right? So we've got a little bit of a deficit here, right? $2 million in loss, we've got $1.67 million in funded, so we've got a bit of a deficit. So about $333,000 sort of in the hole, if you will, right? Year two, we have another $2 million in loss. The insured funded another $1.67 million in premium for year two. Now we've got a little bit more of a deficit, right? So now a deficit of $667,000, right? Year three, good news, we've got no losses. The insured funds another $1.67 million. So now we have a surplus of $1 million. So here the funded premium was $5 million. The losses were $4 million. That's great. There's a low claims bonus of $1 million that goes back to the insured. Right? So in this case, the aggregate stop loss did not need to step in because the losses were lower than the funded premium. Scenario two, though, let's say the losses are greater than the funded premium. Right, so if we look at year one, we have $2 million in loss, right? So we have that same deficit, right, between $2 million and the funded $1.67 million, or $333,000. Year two, good news, we've got no losses. The insured funded another $1.67 million. So now we've got a nice surplus built up there, $1.33 million. Then year three hits, and now we have $10 million in loss that year. within that layer. The insured funded that third installment of the $1.67 million. Now we've got a big deficit, right? We've got a $7 million deficit between the funded premium and the losses. So in this case, this is where the aggregate stop loss would step in. So that's that green $7 million there. The aggregate stop loss steps in and pays that, the amount of loss in excess of the funded premium. Okay? So there's no low claims bonus, obviously, because the losses significantly exceeded the funded premium, but the insured is only out that $5 million funded premium. Okay? So the aggregate stop loss, again, helped kind of stop the bleeding here. So that's one way to go to sort of address losses exceeding funded premium. Okay, so an alternative approach, right? This alternative approach is going to look and feel a bit more like the typical captive, right? So if we kind of trace this again, step one, insurer issues the policy for that $5 million retention. Step two, the insured funds, again, $1.67 million each year. Now they're going to pay a bit of an additional kind of margin, right? So that's to cover the cost of effectively renting the insurer's infrastructure, balance sheet, et cetera, right? So that's going to be admin expenses, profit load. There's some credit risk premium built in there. It's also going to be a bit dependent on the claims burden expected, right? So that's that margin. So the insured's funding that same $1.67 million, just like before. They've got a margin that they're paying as well to sort of rent the insurer's infrastructure. So year three, we've got losses, right? Year one, year two, year three. Step four now, so here we're not going to use an aggregate stop loss. The insured has decided not to do that. There could be an additional premium provision built in, right? Essentially, so built into this insurance policy, if the losses exceed the funded premium, there would be an additional premium triggered, right? So that additional premium would equal the losses minus the funded premium. Okay, so it's another way to do it. So that's mimicking essentially the insured having to recapitalize the captive, right? After losses exceed the amount of premium in the captive, right? So another way to do it, different. Obviously, there's not a function to kind of stop the bleeding there. The insured is just retaining that additional loss. So if we look at that scenario, the scenarios here down below, year one, so we're going to see the same loss pattern here, and you'll see how it behaves a little bit differently in terms of what the insured pays. So year one, $2 million in loss. Year two, $2 million in loss. Year three, no loss, right? So total aggregate loss for the 3 years of $4 million. The insured has funded $5 million. So same exact scenario as before. There's an underwriting profit. The insured gets a low claims bonus. 5 minus 4, or $1 million. Scenario two, here again, this is where the losses exceed the funded premium. Right, so in this case, I won't go line by line, but it's essentially $12 million in annual loss, right, between the 3 years. The insured has funded 5, right? So now 12 minus 5, or $7 million, is that deficit we had. So before, this is where the aggregate stop loss would pay that additional 7, would step in. Here, we have an additional premium provision instead, right? So the insured has chosen to retain that. So an additional premium of that $7 million would be charged to the insured to effectively, again, recapitalize that virtual captive, if you will. So again, no right or wrong way to do it. It really just has to do with the insured's appetite. You know, again, when those losses sort of exceed an expected amount, or when you have a bad stretch of losses, how much does the insured want to take? How much sort of safeguard, or how do they want to cap their downside, if at all, in the event that the losses sort of exceed expectations? Okay, so when might a virtual captive concept here make some sense for the insured? So there are a number of different potential motivations here. So we'll kind of go through a few with these little bubbles here. So number one, again, the insured has concluded that a captive approach, right, the mechanisms of a captive would be an effective way for them to manage their risk. Right? So that's kind of the first step. But the insured doesn't necessarily, again, want to go through the time, energy, effort, admin burden, cost, et cetera, to build a captive themselves. Right? So they like the mechanisms. They don't necessarily want to go the full-blown captive route. Right? So this is a good way to sort of dip the toe in the water, so to speak, right, without having to jump in with both feet. Right? And that kind of leads to the bubble number 3 there. They're wanting to kind of test the waters to ensure that this approach is the right one. Right? They may think it is, but they may want to kind of try it on for size, so to speak, to see if this is in fact the right way to go for them. Right? And this is an important point with a virtual captive. You know, it's basically, so the example we used is a 3-year insurance policy. Right? So the insured at the end of that 3 years, if they decide they don't want to do it anymore, they don't like the concept, it didn't work the way they thought, winding that down, there's really no wind down, right? The policy expires and they're done, right? Whereas with a full-blown captive, winding a captive down is not so straightforward, as many of us know, right? So this is also a nice way for them to sort of test the waters with a combination, again, maybe of an aggregate stop loss to cap the downside, and it's much easier for them to exit if this, in fact, is not the way that they want to go long term. Bullet number 4 there, potentially bridging the time or capital gap here. This is an interesting one. So here, the insured, again, may be pretty convinced that they want to go this route, but they need a bit more runway from a time perspective, right? They need some time to do it, or they kind of need some capital. They want some capital built up to do it, right? So this is actually a really nice way for the insured maybe to go the virtual captive route. You know, hopefully, knock on wood, they build up some capital within it, right? i.e., you know, at the end of the 3-year term, they have an underwriting profit, they get a low claims bonus, and they can then use that to partially capitalize a full-blown captive, right? So they've bought themselves some runway time, and they've also hopefully got built up a little bit of capital to use to ultimately start a captive themselves. Finally, number 5, kind of along the lines of the aggregate stop loss component within the virtual captive, the insured's wanting to minimize that downside if the losses significantly exceed maybe their expectations. Right? So again, a nice way to sort of test the waters in a relatively safe way by capping the downside. So the final message, and then we'll leave as much time for questions as possible. So these tools certainly are not, and we said this at the outset, right? They're not products off the shelf. It's not one thing we take down and one size fits all sort of approach. It's really kind of the opposite, right? They're tools that are very customized, and you kind of get a sense, hopefully, for the different levers that we can pull within these structures to, again, sort of adjust that arrow on that spectrum, right? One way or the other to find that kind of perfect balance for each individual insured. So they're very much customized to the insured situation, exposure, risk appetite, et cetera. So thank you very much for the time. Really appreciate it. Chris, I'll kick it back to you to handle maybe some Q&A. Hopefully we'll get to as many questions as possible, and then whatever we don't get to, we'll certainly reach back out and answer as we can.
Excellent. Thank you, Cole, and thanks for leading us through a really engaging presentation here, as judged by the number of questions that have come through. So let's get right into it. All right, first up, Cole, are these solutions available on any line of coverage or exposure? And there's a question specifically about general liability, auto liability, and kind of longer tail covers.
Yeah, great question. Unfortunately, the answer is going to be it a bit depends. So I'll dig into that a little bit. Generally speaking, our appetite to do a virtual captive, for example, or these solutions in general, it's going to generally be in line with our overall kind of traditional risk appetite, if you will, right? So you know, liability in the U.S., for example, a bit more challenging. Right, so auto we don't do, liability a bit more challenging, property we have a very strong appetite for. So so the longer tail lines, speaking particularly about liability. So if you go into other jurisdictions or other areas, we have a stronger appetite. So Canada, for example, EMEA is another example. So it will be a bit regional and will kind of follow our general risk appetite on the traditional side. Now, again, we do try to some of these structured programs, we can pull those different levers to try to sort of make it so we're a bit more comfortable with lines that we otherwise might be a little less comfortable with. So certain lines, particularly long tail lines, are going to be more challenging. So just to be perfectly transparent there, doesn't mean they're not always going to be sort of not doable. It's possible that we may be able to do something, but the long tail lines will be a bit more challenging. Auto, for example, we don't have an appetite for. So that's going to kind of be out of scope. But I would say in general, it's always good to have the conversation. We can always talk fairly efficiently, reach out and we can say, okay, yeah, this is one that we really won't have the appetite for this line, but maybe we can make this line work, right? So this is kind of another piece or kind of road to go down. Very often an insured might say, well, I want to start with 5 or 6 or 8 lines, right? That may be a challenge, right, from our appetite perspective, but also from a complexity perspective. Sometimes it's nice to start with 1 or 2 lines, right? So we're not necessarily solving their entire problem, but we're solving a more digestible problem for us and for the client, and we can always potentially look to expand later. So Chris, hopefully that answered the question. It is a bit dependent on where we are in the world and what our appetite is, but I always encourage folks to reach out if there's any sort of doubt, and we can give them a relatively quick answer.
Yeah, thank you, Cole. I was going to say the same thing. Yeah, any specifics, please don't hesitate to reach out to us on those. All right, so next question pertaining to virtual captive solutions. Is there an annual funded premium to make these, like minimum funded premium to make these solutions viable or kind of make sense?
Yeah, that's a good question. I wouldn't say we have a hard rule, Chris. These are a little bit more complex. They do take some heavy lifting both for us and for the broker and for the client, right? So they've got to kind of be worth it, I guess, for all parties, so to speak, right? Probably not a hard and fast rule. I would say, I'm going out a little bit on a limb here. I would probably say, if the funded premium is depending on the expected loss and the exposure and all the rest, 200 to 250 a year, now we're kind of starting to get into a pretty nice size. And that's going to be a bit dependent on the limit we do as well, right? But I would say it's probably anything much lower than that is going to be a little bit of a challenge, again, given the complexity and the time we're going to spend on this. We all collectively will. So again, sorry to be not super definitive, maybe a little bit of an annoying answer, but it will a bit depend. I would encourage folks to reach out, even if it's maybe on the cusp from a size perspective. It's still worth having the conversation, and there's a possibility we can make something work. Hopefully that gives people a little bit of a rule of thumb, but also flexibility to reach out if they have one that's sort of on the fence, so to speak.
Thank you, Cole. Next question, back to virtual captives. What are some of the disadvantages or challenges you see with virtual captives?
Yeah, that's a good question. So I'm not sure there are disadvantages per se. I guess maybe what I would say is there are just differences in terms of approach, right? So, for example, if the insured, is willing to sort of incur the admin from a regulatory perspective, cost perspective of owning a full-blown captive, right? That's kind of an owned entity, right? So naturally they're going to have a bit more flexibility in how they utilize that. So I guess that would be an advantage maybe to the full-blown captive route as opposed to the virtual captive route. So I wouldn't say there are necessarily advantages or disadvantages per se. It's more, what sort of outcome long-term does the client want? right? If the client is very certain and they want to go down the kind of full-blown captive road, nothing wrong with that. There's no wrong answer there. They just are going to incur a bit more cost administration on the front end to do that, right? But on the back end, they may, maintain a bit more control than if they go the virtual captive route, So, again, maybe the advantage is a bit more control on the full-blown captive side, a bit less control on a number of different factors for the virtual captive. That's obviously going to be balanced out with, with that control on the full-blown captive side. They're going to have more regulatory requirements and admin cost and claims adjustment expense and all of that stuff that goes with it. So that's, I guess, a bit the disadvantage to the full-blown captive route, and maybe the advantage to sort of getting the mechanics of a captive with the virtual captive route, but kind of renting the insurer's infrastructure to do it. So hopefully it answers the question. No right or wrong answer. It really just has to do with the insured's preferences in terms of control and the best long-term solution for the client at the end of the day.
Thank you, Cole. Next question, back to virtual captives again. Does this assume all is insured through a captive, or does this attach to an excess risk transfer program?
I want to make sure I understand the question exactly. So with the virtual captive concept, there is actually no captive involved, right? And maybe I'm misunderstanding the question. So we're effectively, it's an insurance policy directly with an insured, so a corporate or a public entity or what have you, that's replicating the mechanics of the captive. Now, maybe the question is around, can you put a virtual captive layer kind of in a higher position in a tower, for example? It's possible. I would say that, very often these are used down low, right? Again, to sort of address the retention layers, if you will, as opposed to use, in various areas of kind of an excess tower. So the value, I think, really kind of is much more unlocked, if you will, down kind of below, as opposed to in kind of a middle excess layer, for example. I may have been misunderstanding the question, Chris. I apologize if I did. If we don't answer the question, whoever asked, feel free to reach out again, and we can engage kind of in more detail.
No, I think that was a good interpretation of the question. Cole, I just read it as written, so thank you for that. I think that was helpful. And again, if it wasn't addressed, please do reach out. We're happy to talk through it over the phone. Probably maybe our last question, and we received so many that we're going to try to reach out to you directly, if that's okay. The last question goes back to your aggregate stop loss portion of the presentation, Cole. So is an ag stop loss possible in a normal single parent captive, or is the mechanism only available for virtual captive?
Yeah, really great question, and the answer is yes, it's absolutely available for captives as well. Yeah, and we execute those pretty regularly. So yeah, and it's a very astute question, actually, right? Because if you can put an aggregate stop loss in a virtual captive concept, right, can you do it just kind of with a full-blown captive, right? So obviously you wouldn't have some of the attributes of a virtual captive, right? The funded premium and all that, that's going to be handled by the full-blown captive. But we absolutely can execute a kind of a standalone aggregate stop loss for a captive, and we have done many of those. Yeah, so very good question, astute question, and yes, we absolutely can do aggregate stop loss for full-blown captives as well.
Excellent. Thank you, Cole. Okay, everybody, I want to thank you all for spending the last hour with us. As Cole said at the opening, you have a lot of choices, and we really appreciate your time here. I've put up a poll for you just to quickly complete before you leave. Let us know how we're doing, because we're going to continue these. And if you have ideas for webinars that you'd like us to address in the future, don't hesitate to reach out. Cole, thank you so much. You're fantastic. I think this is very interesting and hopefully useful to everybody who's joined us today. And a thank you to Alex Monsian, our colleague in communications that makes all of this stuff possible. And as always, please keep an eye out for our Swiss Re Corporate Solutions LinkedIn feed, where we'll be announcing future events. A link to the recording will be sent to all attendees probably early next week when it's available. So feel free to share that with colleagues or rewatch at your convenience. And as always, take good care and enjoy the rest of the week. And we look forward to speaking with you again soon. Thank you.